Hi, this is Majin from Beerology University. Let's begin today's Beerology news for September 22nd. Welcome back to Midterm, where we always focus on the basics of investing in United States stocks. Midterm babies, I hope you had an enjoyable, relaxing and fulfilling weekend. I overworked myself a lot 2 weekends ago, so this weekend I really took the time to rest as much as I wanted. I spent a lot of time in bed, and I even took naps on both Saturday and Sunday, which I normally don't do. Because of that, I feel like some of my fatigue has gone away. And one more thing, I exchanged a lot of emails with Mijun subscribers over the weekend, and since it's a pretty interesting episode, I'd like to briefly share it with you. Recently, while reading your comments, I exposed my email address a few times. For example, even 3 days ago, someone with the username Emily and Cat left a comment like this. Mijun, could you please offer the 50% discount on the membership just one more time? They left a comment saying, I regret missing the timing and not signing up earlier. Stay healthy. I just couldn't ignore it again. It was weighing on my mind. So if you look here, I left my email address, and for those who email me individually like this, I personally contact the manager in charge of banding. Also in May, I helped you become a Mijun member or Yon member at a 50% discounted price. But now there's a problem. After leaving my email address a few times like this, my email address ended up being exposed too much. So over the past weekend, I received dozens of emails from you all, and as I was replying to each one of them, I ended up spending so much time just working on and writing emails. But in my case, it's good because the popularity of the Mijun membership I'm running is going up. However, one thing that bothers me is that the managers at Banding who manage the Mijun membership had to work overtime, and their workload increased because of me, and I felt bad about that. So since things have turned out this way, I thought there's nothing I can do about it now. I decided to hold a surprise 3-day sale. So today is September 22nd. For just 3 days, Monday, Tuesday, and Wednesday, I reopened the 50% discount link. Not long ago, I posted something titled Mijun Membership Surprise Discount Event. If you look here, I included a link. So through this link, you can sign up for the Mijun annual membership at a 50% discounted price for just 3 days. If any of you are considering it, I really hope you all take this opportunity to sign up together this time. For those of you who recently found out about Mijun and missed the last Mijun discount event, I want to let you know that I don't have any plans for another discount event for the time being. So I hope you'll take advantage of this opportunity and become a member of Mijun. From now on, I will have to politely decline any individual requests for membership discounts. Well, I would also like it if there were more buses. The problem is, it seems like it causes some trouble for the managers working with us, so that's why I'm asking for your understanding. For those of you who have been thinking about it, or who have considered joining the Mijun membership during these next 3 days, I would like to once again express my hope that you will please sign up. Let's start today's United States stock news for September 20th as the new week begins.
The beginning is important, so let go of your greed.
Every day.
Grow little by little every day and enjoy today's journey. Even when dark times come, I'm not afraid. Retire with United States stocks.
This is the Monday broadcast to start a new week. Let's begin by reviewing recent United States stock market conditions and last week's events. First, if you look at the S&P 500 map, I've set the period to 1 week. At a glance, the number of rising stocks is clearly overwhelming the number of falling stocks. So you can see that the United States stock market continued its upward trend over the past week. The tech stocks we favor performed very well. All Magnificent 7 stocks gained except Nvidia, which still rose 0.65%. Recently, there has been a lot of bad news coming out of China, so some semiconductor stocks, including Nvidia, have dropped a bit. The rest of the tech stocks performed very well. Especially the blue color is very bright, so we can guess that the increase was quite significant. And on the other hand, if you look at the sectors that fell, consumer defensive, that's essential consumer goods. Essential consumer goods are not affected by the economy. Now, if you look at other sectors that are not affected by the economy, there are also many healthcare stocks that have dropped. And not only healthcare, but utilities have also fallen a lot. That means there was something good for the economy. In other words, there are two positive factors. First, the Fed has started to cut interest rates again. When interest rates are lowered, it stimulates the economy, so the economic outlook could actually improve in the future. And the second is, news came out that the economy is actually much stronger than expected. Therefore, since the economy is still stronger than expected, and interest rate cuts that can continue to support this economy are starting. So, the stock prices of sectors that are sensitive to the economy are doing well, while the stock prices of defensive stocks, which are not affected by the economy, have actually fallen. We can say that funds have moved or flowed out in this way. And if we look at the movements of the major indices in the United States stock market over the past 5 days, we can once again see what kind of capital flows occurred during the week. Over the past 5 days, the microcap index had the best stock performance. Microcap refers to very small cap stocks, so these microcap stocks have been continuing to rebound significantly recently. And right after that is the Nasdaq 100. The Nasdaq 100 is an index that tracks the top 100 blue chip stocks with the largest market capitalization listed on the Nasdaq. Financial stocks are not included. Therefore, you can see that tech stocks also showed a very good trend, rising by 2.16%. The S&P 500, the main United States index of top 500 companies, posted a solid 0.96% return. Now, if we go down and look at the performance of the 11 sectors that make up the S&P 500, we can easily see which sectors are doing well. Technology led with a 2.97% gain. Second was communication services, which includes Meta and Google, up 1.76%, and consumer discretionary, supported by Amazon and Tesla, rose 1.16%. So cyclical stocks and sectors performed well over the past week. You can confirm this once again. Well then, the mid-cap picks must have done well, because all the mid-cap picks are tech stocks. And also, as interest rates are being lowered, recently Bitcoin-related stocks have performed well if you look at their movements over the past week. Tesla led with a 7.61% increase. Astera Labs gained 6.84%, Palantir 6.39%, Coinbase 6.01%, Alphabet 5.78%, First Solar 5.35%, Talon Energy 5.2%, Credo 4.67%, Celestica 4.62%, Strategy 4.02%, Meta 3.2%, Taiwan Semiconductor Manufacturing Company 2.14%, and Vistra 0.75%. Some stocks fell during the week. Bitcoin, however, traded sideways with 114,500 in circulation. Nvidia slipped 0.65%. Advanced Micro Devices dropped 0.74%. B2 fell 3.37%. Broadcom lost 4.15%. And the ProShares Ultra Ether Exchange Traded Fund, which tracks Ethereum, plunged over 6.7% Friday in a correction. Fortunately, the futures index is currently rebounding by 1.5%. All right, then let's neatly go over the remaining market indicators as well. First, the S&P 500 breadth. It's about market breadth, right? What about it? Based on Friday's closing price, 56.26% of the stocks have a good short-term trend. That means the stock price is above the 50-day moving average and also above the 200-day moving average. Stocks with a long-term upward trend make up 59.84%. The fact that nearly 84% of stocks have a good trend means that this rally has a solid foundation. If market breadth narrows, stocks that have risen sharply could suddenly drop. The fact that not just a few stocks, but many stocks are rising simultaneously proves to us that the trend is very healthy. It's maintaining a very positive outlook. Next is the volatility index. Now, Since the market continues to rally and the breadth of the market is also stable, the volatility index is very low. We still see a healthy volatility index at 15.45. Now, since the 200-day moving average is at 19.12, it seems highly likely that this Goldilocks atmosphere will continue for a while. Next, the Fear and Greed Index shows the same result. I mentioned that it's stuck in a box range here. The upper limit of the box range was 75 and the lower limit was 50. So, the fact that it keeps moving back and forth between 50 and 75 is actually very positive. Also, 62 is nearly in the middle of that range. So for now, you can see that this reflects a very stable market sentiment. The market score provided by Choisita is also 80. It's the same here as well. So the current score of 80, that once again proves to us how steady and stable the upward trend is continuing. This is also a box range, right? I mentioned that unless it drops below this or shoots up above, it's very positive. Currently, market score is also staying in a very positive, greedy phase. That's how you can see it. Now, the most important thing is how long this good trend can last. Looking at historical statistics, such a positive trend is not expected to continue. Let me explain in detail what this means to you. Now, the second half of September is starting, and the stock market is often said to be weak during this period. Now, there are less than 10 days left in September for the United States stock market, and historically the statistics for the remaining period are not very good. This week, the Federal Reserve cut interest rates for the first time in 2025, and the market breathed a sigh of relief for the month. The market has switched back to a risk-on mode, favoring risky assets, and people cheered as if the rally would never end. The atmosphere is very positive now. However, looking at history, there are warnings that the stock market could struggle in the second half of this month. According to LPL Financial, the September stock market has shown a clear tendency for performance to differ between the first and second halves. Generally, in the first half, historically the United States stock market tends to move sideways or show a slight upward trend in the first half, but in the second half, as the month comes to an end, stock prices tend to decline. Now, if you look here, the historical statistics of the S&P are shown as averages. They collected statistics from 1950 to 2024. We know that September isn't very good right now, but it's not bad for the entire month. As you can see, it's okay until about the 14th, and then it starts to drop little by little from this point. And it continues to show a downward trend until the end. This isn't showing the monthly chart from the 1st to the 31st. It's actually based on trading days. So it's okay up to about the 14th trading day. After the 20th trading day, the stock price starts to fluctuate. That's how we can sum it up. In September, the United States stock market continued its record rally. The S&P 500 is up over 3%, while the Nasdaq Composite has climbed nearly 5%. That's why, even though we used to think September was a really bad month, it's now overturning its image as the worst month. According to experts, these results reflect the momentum of the macroeconomy and the market trends. Adam Turnquest, the chief technical strategist at LPL Financial, appears. According to this expert, with the end of this Federal Open Market Committee meeting, we have passed the biggest risk event in September. The United States stock market is trading near all-time highs. The Fed did not deliver a hawkish surprise. This was also very positive. And it is being summarized that the resumption of the rate cut cycle helped offset seasonal headwinds and allowed risk appetite to be maintained. However, it notes Wall Street's usual caution persists. That's because at record highs and peak price levels, high valuations can make the market more vulnerable to volatility. Therefore, there are also experts who argue that we need to be prepared for a correction or a sideways market. Nevertheless, some indicators are still showing that there is room for the stock market to rise further. Let's take a look at what those aspects are. Next up is Nationwide's chief market strategist, Mark Hackett. Investor sentiment isn't extremely optimistic yet. He makes an important point. For example, the American Association of Individual Investors, Inc., sentiment indicator shows this. The bullish ratio announced last Thursday was 41.7%, which is slightly above the historical average. But as we've already looked at together, the bearish ratio is very high. Average is 31%, but up to 42.4% of investors agree. 6 months later, the United States stock market dropped. This means many individual investors have already sold their stocks and are now waiting for a correction. That's how you can view it. Now, this is also very positive. Another thing is cable news network's Fear and Greed Index. As of Friday morning, the Fear and Greed Index is 62, indicating greed. Just a week ago, it was neutral. So based on these two indicators, it appears market participants are they're not showing the kind of euphoria we saw at previous market peaks. So paradoxically, this rally still has plenty of room to run. That's how we can interpret it. So, according to the expert Mr. Hackett, whether you look at the Fear and Greed Index or the results of the American Association of Individual Investors survey, and there's one more thing, he says that a large amount of money is continuously flowing into money market funds and bonds. That means institutional investors still haven't been able to muster up the courage yet. Now, when you look at this kind of money flow, you can see that it's different from the kind of activity you see when the stock market is at its peak. Since August, the market has ignored seasonal patterns, the chance of a correction after the Fed, and volatility from major economic indicators, contrary to bears' expectations. Instead, it continues to rise steadily each day. We've enjoyed this and call it a Goldilocks scenario. Now, this phenomenon it's being compared to a situation that's like 1,000 small cuts for the bears. Why is it called 1,000 small cuts? Actually, if the stock price goes up 3% or 5% in a single day, it usually drops again quickly, so it doesn't leave that many wounds. But the problem is, for the past few months, it's been creeping up little by little, so it's not surging, but it's steadily going up bit by bit. From the perspective of a bear, it's actually a very tough situation where you can't even buy more stocks and your wounds just keep piling up. All right, let me sum it up in one word from Miji1, as you all know me as well. I consider the sentiment indicators mentioned in the article above, such as the American Association of Individual Investors survey results and the Fear and Greed Index, to be very important, as well as the current market indicators. I also completely agree with the claim that this is significantly different from the activities seen when the stock market is at its peak, which means this. There is so much cash on the sidelines waiting to buy stocks that it's hard for the United States stock market to enter a major downward trend. That's how the logic can be explained. However, this logic is often understood as a claim that the probability of the United States stock market experiencing a major drop or correction, like a 10%, 15% or 18% decline as seen last April, is low. So, in other words, this doesn't mean that there won't be occasional declines of 3%, 5% or 6%. You shouldn't interpret it that way. Because every investor participating in the market has a different investment horizon. That means there are people who invest for a month and then sell, and there are people who invest for just 1 or 2 weeks before selling. With the United States stock market rallying, many people will likely sell their shares, creating selling pressure. Therefore, regular technical corrections are unavoidable. We always need to remember that this is an unavoidable part of investing in stocks. Only by understanding and preparing for these market traits can you use a momentum strategy or be ready if you steadily accumulate stocks without selling. Whatever strategy you choose, you'll have the strength to withstand a correction and weather the storm without being shaken. If we want to be a bit more ambitious, there's one more thing we can add. If each investor secures an appropriate amount of cash, they can assess the situation more objectively. They gain the ability to make rational and reasonable decisions. Usually, when a correction happens, people's emotions are greatly shaken. In that case, there's a high chance they might make decisions emotionally, lose their rationality, or make unreasonable choices. That's why we keep a portion of our assets in cash. Stock market corrections are always tough for a reason. Corrections always happen, but the reasons behind them vary. So it always feels like the outcome will be different this time. But we've experienced it ourselves, so now we kind of know. Whether the reason for the stock market drop was a virus, a war, or a trade war, it wasn't any different last time either. That's why experience is really important in stock investing, so we need to remember these experiences. When the upcoming correction happens, I hope you won't avoid or run away from it, but instead become a wise investor who uses the cash you've secured to increase the number of stocks you own. The next article also covers the United States stock market outlook. Historical statistics appear again this time. As you all know, I refer to historical statistics quite a lot. As I've said before, stock investing means putting money into an uncertain future that's never fully predictable. So, when you invest with such uncertainty, you have to increase your chances of success by any means. And to do that, it's very important to refer to past statistics. This is the investment logic that I follow. Looking at the article's title, it's about the Federal Reserve's historical interest rate cut patterns. So, you can understand it as a comparison of which is stronger, the Fed's rate cuts or the historical patterns, and which one will prevail. Okay, let's begin by reading the article. What about the Federal Reserve's decision to ease its monetary policy? David Kostin, a United States equity strategist at Goldman Sachs, says this could extend the rally in the United States stock market. The expert named Kostin, in a recent report called the United States Weekly Kickstart, said this. He argues that despite the slowdown in economic growth, interest rate cuts could boost stock valuations and the outlook for corporate earnings. We need to take a closer look at this. Now, this is a report that was released on September 19th. The additional rise in the stock market during the Fed's rate cut cycle is consistent with historical patterns. As I've emphasized several times, during the Fed's rate cut cycles, the stock market usually rises. The exception is when rate cuts happen at the same time as the United States economy slows down. In other words, when it falls into a recession. So unless the economy enters a recession, Fed rate cuts lead to a stock market rise. That's one way to see it. Kostin, he says the S&P 500 index is expected to rise moderately from its current level. He also added that if inflation eases and the Fed maintains a dovish stance, even higher levels are possible. He emphasizes that falling bond yields lower the equity risk premium, making stocks appear more attractive than bonds. Now, what this means is, here are the bond yields. We usually discuss the interest earned from investing in bonds, right? So if the base rate falls, the bond yield will likely drop too. Now, when the interest you receive from buying bonds goes down, the equity risk premium decreases. Now we call stocks risky assets, right? And bonds are safe. They're safe assets. So if you're going to invest in risky assets, instead of just sticking with safe assets, you need to expect a higher return, right? The difference in expected returns like this is what we call the risk premium. But when bond yields fall, of course, the risk premium we expect when we buy stocks also decreases. Therefore, we can understand the situation as having enough value to give us the courage to buy stocks. By sector, it is expected that housing and finance, which are sensitive to interest rates, as well as some tech companies related to capital expenditure, will benefit the most. Well, of course, when interest rates fall like this, it's obviously good for housing because mortgage rates go down. When we buy a house, we usually get a mortgage, and if the mortgage rate is too high, demand for housing is bound to decrease. Therefore, if the base interest rate continues to fall in the future, housing demand will inevitably rise. And when housing demand goes up, a lot of other sectors benefit when a house is built. Think about it. Various sectors contribute to completing just one house. So there are companies that make doors, companies that make tiles, companies that make paint, and companies that make lumber. In order to build just one house, countless industries contribute. So when the housing market improves, other industries usually do well too. The improving housing market is important, and the finance industry, sensitive to interest rates, is also likely to perform well. And finally, the tech stocks that we care about, if interest rates drop in the future, since they require a lot of capital expenditure, the interest rates need to be low for the borrowing costs to be lower. Therefore, many sectors can benefit from this simultaneously. Therefore, you can see that the United States stock market can continue to rise. Now, what about defensive sectors like healthcare or consumer staples? They argue that as investors return to cyclical growth stocks, these sectors may relatively underperform. Now, even though we've talked about this rosy outlook, they're still warning that risks remain. Corporate profit margins are still under pressure from persistently high wages and input costs. And they're also warning that political uncertainty ahead of the 2026 midterm elections could dampen investor sentiment. Now, the 2026 midterm elections are very important. I'll explain this in more detail a little later. Also, Costin argues that as long-term interest rates remain relatively stable, earnings will become the main driver of the stock market going forward. He made a very important point. He goes on to explain this further below. What is Goldman Sachs' base scenario? They are assuming two 0.25 percentage point rate cuts by early 2026. They expect this will help stabilize financial conditions without causing a surge in inflation. This is what's famously known as the Goldilocks scenario. Inflation doesn't spike, and with stable financial conditions, the economy improves. This lukewarm state, neither too hot nor too cold, is called the Goldilocks scenario and is our favorite. What about Costin? The credibility of the Fed in maintaining growth while also achieving price stability will be key to sustaining investor confidence. They're saying if a Goldilocks scenario occurs, the stock market will keep running. Goldman Sachs also expects S&P 500 companies' earnings per share to grow 7% this year and next. Earnings per share means dividing the net profit by the number of shares issued. This means that for both this year and next, these companies' net profits are expected to grow by 7% annually for 2 years. Costin said stock valuations have historically been driven by high growth rates. However, considering the macroeconomy and corporate fundamentals, it seems to be at a level close to fair value. So it's not too costly either. How about an accommodative Fed and a faster growing economy as we approach 2026? This will help maintain the current stock price level, or multiples, and future gains in the United States stock market will be driven by earnings growth. Now, what this means is, as I always say, stock prices are earnings multiplied by multiples. Stock prices are earnings times multiples. What Costin is saying now is that multiples won't change going forward. They're already high, but the point is that they can maintain this high level. As you can see here, earnings per share or earnings are expected to rise by 7% this year and 7% next year. So, if earnings go up and the multiples stay the same, stock prices will also rise by 7% this year and another 7% next year. That's how you can wrap it up. Now, this time, I'll share with you some historical statistics about the midterm elections that I mentioned earlier. The 2026 United States midterm elections are set for Tuesday, November 3rd. Now, while I was reading the article above, I grew curious about the United States stock market's historical performance during midterm election years. When we usually think about it, we tend to predict that the ruling party will try to boost stock prices to achieve good results in the midterm elections. However, the results were different. There have been 19 United States midterm elections since 1950. We reviewed historical statistics on the S&P 500 index's total return. As shown, we analyzed performance in the 12 months and the 6 months leading up to the midterm elections separately. The probability of an increase over 1 year is 55%. Out of 19 times, it went up about 10 or 11 times. Unfortunately, the average return is within 1% and the median is 0%. Starting a year before the election, Mr. Mi Hook-jun. As uncertainty grew, clear upward trends were often absent. Of course, because volatility was high, it went up and down, but if you look at the whole year, it didn't really go up much. That's how you should see it. And if you look at the 6 months before the midterm elections, the results aren't as good. The probability of an increase is only 45%. In the 6 months before the midterm elections, stock prices dropped more often than they rose. The average return is -2%, and the median return is also -1%. Now let's make a comparison. So what about the 12 months after the midterm elections? Statistics show a 100% increase historically. Since the midterm elections are next November, expect a 100% increase for 1 year after that. The average return reaches 14–16% with a median of 13%. In summary, the market was nearly flat for the 12 months before the midterm elections, with many negative returns over 6 months. But the encouraging part is that after the midterm elections, there has historically been a strong rally with a 100% increase. That's how you should see it. Now, there's one more depressing statistic. Based on market data from 1933 to 2015, you can see the returns by each president's term. The worst year is the election year. That's the second year, and President Trump is currently in his first year. In the first year, the market rises about 6-7% on average, but in the second year, it increases only about 3%. So, if you look at a typical 4-year term, the worst performance usually happens in the second year. That's how you should see it. Trump served one term as president, and his performance was the same then. As you can see, in the first year it was very good with plus 19.5 and 42%. In the second year, 2018, it was the worst with minus 6.24%, and the third year was the best with plus 28.8%. Therefore, looking at the overall historical statistics over the next year to a year and a half, the United States stock market could see increased volatility, and there is a good chance that stock prices may not move in the direction we want. There is one major variable here, and that is the fact that the Fed has started cutting interest rates again, which is a major positive factor. However, even so, it's very reasonable to expect that the volatility of the United States stock market will be extremely high over the next year. Investors should maintain their preferred cash ratio and buy during market corrections at low prices. Personally, this is how I see it. The last content prepared for today is the Midterm podcast, which we haven't had in a while. Today's main topic on the Midterm podcast is Tesla. Tesla is a stock that really fits the phrase love-hate relationship with Tesla. I think it's also the stock that has been bought and sold the most frequently on the Midterm channel. That's because the momentum changes so much. When the momentum goes up, I buy more, and when the momentum drops a lot, I sell and adjust the proportion. Tesla is the stock I've adjusted the most frequently, if I'm not mistaken. As Midterm members know well, I increased my Tesla stock holdings a lot a month ago, and fortunately, Tesla's stock performance over the past month has been very good. It's risen sharply by over 20%. Even at this point, there are strong buy recommendations for Tesla, so I'll make this article into a podcast and listen to it together with you all. I want to remind you once again that this is not a buy recommendation for Tesla. That's all for the content prepared for September 20th. I sincerely thank everyone who stayed with us until the end of today's broadcast. And as I mentioned at the beginning of the broadcast, today, tomorrow, the day after tomorrow, and until Wednesday, we're hosting a surprise 50% off event for Midterm Entertainment membership. For those of you who have felt that you need the Midterm membership, I hope you'll take this opportunity to join us. Let's keep fighting together until we retire from United States stock investing. Have a happy day, thank you.
Hello, Midterm family. Are you having a good start to your Friday?
This week went by really fast because Monday and Tuesday were holidays.
Hello everyone! I hope you're having an energetic start to your Friday, and I'll get right into the analysis article. Today, it's a Tesla analysis article, and even the title by analyst Baider Deogonov is really eye-catching. It's about why you should strongly buy Tesla stock. Lately, there's been a lot of news about Elon Musk. I'm really curious about what kind of evidence they're presenting.
Yes, so today we're going to dig a little deeper into this material. Let's take a look together at why this analyst didn't just rate Tesla as a buy, but as a strong buy, and how he's viewing Tesla's future value, and go over the key points. I'll pick out the information that will be most helpful for you in making your investment decisions. All right, then let's get right into the main topic. The analyst's primary reason for recommending a buy is Elon Musk's actions. Yes, there was a recent $1 billion share buyback.
Yes, I heard about it. $1 billion. That's really a huge amount. Isn't it a bit hard to see this as just a simple investment? How are analysts viewing this?
That's right. Analysts see this as clear evidence that Musk has strong confidence that Tesla's stock price will rise much higher in the future. At the same time, they also interpret it as an attempt to secure some sort of downside protection to prevent the stock price from falling. Furthermore, some say that maybe Musk is trying to strengthen his control over the company in the long term. Some even speculate that this could be the start of a plan to increase his stake to about 25% understood.
It's interesting that this 1 billion purchase may only be the start. So what's the second reason? Do you mean future growth engines?
Exactly. This is where the analyst's perspective stands out. Tesla should be viewed not just as an electric car company, but as a tech company making wheeled robots.
Wheeled robots? That's an interesting way to put it. So does that mean you see much greater potential in new businesses like full self-driving, or robots, rather than traditional car sales?
That's correct. Especially full self-driving artificial intelligence and robotics. These two could actually become more important for profitability than the car business itself within the next 5 years. That's how I see it.
Oh, there are already places that have been approved? Yes?
This isn't just about adding a feature, it's about Tesla shifting from selling hardware to earning from software and services. The logic is that, like other tech stocks, they deserve a high valuation and higher multiple.
Wow! Saying that full self-driving alone is worth $1 trillion is a really bold prediction. By the way, did they mention anything about the robotics business? Are you talking about Optimus?
Of course, we can't leave out the Optimus robot. Elon Musk himself once said that this robot business would account for about 80% of Tesla's future value. Analysts believe that this robot business could create more than $1 trillion in value within the next 5 to 10 years. Some other institutions even predict that the humanoid robot market itself could grow to an enormous size, up to $4 trillion or even as much as $7 trillion. If Tesla really takes the lead here, the company's value could grow beyond anything we can imagine.
Wow, robots could really become the key driver of future value. I think we need to start looking at Tesla from a completely different perspective. Based on this kind of potential, what kind of target price are analysts suggesting?
First of all, by 2030, they're expecting sales of $330 billion and an earnings per share of about $20. But what's interesting is that they're drawing a clear line, saying this is a conservative estimate.
This is considered conservative?
If new businesses like full self-driving artificial intelligence and robotics really start making money successfully, the stock price could rise to a much higher range of $2,500 to $3,500 within the next 5 to 10 years. They're also presenting an optimistic scenario.
With the stock price between $2,500 and $3,500, there's huge growth potential. Of course, it's not all good news, right? Were there any risk factors?
Of course, that's definitely mentioned. First of all, the competition in the electric vehicle market is getting more and more intense.
That's right, the competition is fierce, and
The implementation of full self-driving technology could be more difficult than expected, or competitors like Waymo could catch up. It's the same in the robotics field. New competitors could suddenly emerge. These are considered major risk factors. And there's also something we can't leave out, the unpredictability related to Elon Musk, what we commonly call the Musk risk. This is also being pointed out.
that's really something that always comes up.
They're also noting concerns that the stock price is already high, citing this valuation burden. From a technical analysis view, the relative strength index indicator is nearly 80, signaling short-term overbought conditions and a possible short-term correction. They're noting this too. You always have to keep various possibilities in mind when investing. So to sum it up, the analysis by Victor Dugnev that we looked at today says that Tesla's future value ultimately depends on innovative technology platforms like full self-driving artificial intelligence and robotics. And it's Elon Musk's vision leading all of this that people are counting on. People are betting on Tesla's explosive growth potential as a technology company, not just as a company that makes electric cars.
After hearing this, it seems clear that Elon Musk's purchase of company stock in October is definitely not something to overlook. The robotics business could have even more potential than we expected. That's impressive. Yes, I think it's time to reconsider the way we evaluate Tesla's value itself. The analyst even claims that Tesla's market capitalization reaching $8.5 trillion might not be just a fairy tale. What do you all think? Do you really think Tesla can successfully go beyond being just a car company and become a leading artificial intelligence and robotics company? I'm curious to hear your thoughts on this incredible growth story.
Thank you for being with us today. Have a wonderful day.
Thank you.
The beginning of a small dream is important. Shall we plant a hopeful future together? Growing little by little every day. Is there excitement blooming in your heart? Release your greed. This time won't change. The result is just a continuation of the process. Even if a dark adjustment comes, I'm not afraid. Holding on to Miju's hand, I'll move forward and become the light for the unseen tomorrow. Happy investing, supporting each other's dreams. Let's walk together down this beautiful downhill path. Happy investing with Miju, all of us together, until the day we all boldly retire as national poets. Korean subtitles.